Here again with Smart System. In our last lesson, we discussed non-farm payrolls and why this number can have such a large effect on the markets. In today's lesson, we're gonna discuss another indicator, which can create lots of market volatility: retail sales. So let's get started. The retail sales numbers, released at 8 a.m. on or around the 13th of each month, and is an estimate of the sales of goods by all retail establishments in the United States. These goods fall into the personal consumption expenditures category, which, as we discussed in our lesson on GDP, makes up over 65% of the US economy. Although, the number does not include anywhere near the data that's included in GDP, since this number is released for each month, where GDP is released for each quarter. It's closely watched by the Fed and other market participants as a timely indicator of what is happening with the consumer. In addition to the widely reported headline number, the report is issued, or the report that's issued, along with the retail sales number, includes a breakdown of retail sales growth by category. With this in mind, the report is not only a good indicator of overall consumer activity, but also for how different parts of the economy, such as automobile, restaurant, clothing and electronic sales are faring. If you're trading a stock of a company which sells products related to one of the categories reported in the retail sales number, it's obviously important to understand that what happens with the growth of that category is most likely gonna have a direct effect on the price of the stock you're trading. For those of you who like to view the support, the retail sales number is not only looked at for its timely reporting on growth of a large part of the economy, but also for its predictive powers regarding inflation. A healthy economy should show strong retail sales number. However, if the number grows too quickly, then there is a danger that growth and consumer demand will outpace supply growth, causing prices to rise, enforcing the Fed to raise interest rates to rein in growth. To predict how the market will react to increases or decreases in the retail sales number and understanding of where the economy is in the business cycle, as we learn in our lessons on that subject, is necessary. For example, in a period where inflation is thought to be contained and growth is a worry, then a strong retail sales number should rally the market. However, we're in a high growth period already. Then a strong retail sales number can cause market sell-offs as participants anticipate Fed interest rate increases to rein in growth. As with every economic number we study, remember that markets anticipate, so the market reaction will more times than not have a greater dependence on where the number comes out in regards to consensus estimates, rather than how strong or weak the number is. In general, if the number comes out in line with estimates, then at least in theory, this should already be priced into the market, and therefore, market volatility after the number should be contained. If over the number comes in off estimates, then you can see dramatic market volatility, the size of which is gonna depend on how far the number comes in off estimates and where we're at in the business cycle. As with all the indicators we're starting, you really have to follow the number for several releases to get a feel for what the market is focused on and how it's going to react under different scenarios when the number's released. That's our lesson for today. In next lesson, we're gonna continue our discussion on economic numbers. So we hope to see you then. As always, if you have any questions or comments, please feel free to post them in the comment section. And good luck with your trading. Have a great day.